What pops into your mind when you think about stock market traders? If you imagine Nikhil Kamath in a sharp tuxedo or Rakesh Jhunjhunwala in his crumpled shirt, you are not alone. We've all heard tales of big shot traders and how they have made big bucks in market. Now I get it. It seems exciting. But let me tell you one thing. Trading sounds a lot simpler than it actually is. And if Nikhil Kamath is watching this video, he would agree with me that even the best of traders face the same challenges as you and I. See, markets treat everyone alike. Irrespective of how expert or experienced you are, you still have to face the daily ups and downs, checking out trends, and deal with emotions like fear, greed, hope, overconfidence, and regret. Now, among all these everyday struggles a trader faces, one of them is also taxes. And while I'm not having solutions for all your trading woes, I can certainly make one aspect a bit less painful: taxes. Understanding the ins and outs of taxation on your trading income can be the difference between safeguarding your capital and watching them go to the taxman. So whether you are a seasoned trader or just starting to dip your toes into the market, grab a notepad and stick around with me today. Hello, I'm Vishvajit Sonagara, founder of Quico, India's leading tax filing platform. In today's video, I'll tell you everything about income tax for traders. We will understand how trading in stocks is just like any other business, how do traders make money and how it's taxed, what to do when you incur losses, what is tax audit and when is it applicable, and lastly, how to file taxes as a trader. But before we dive in, hit that subscribe button and notification bell so you never miss out on any of our upcoming videos. Without any further ado, let's get started. Alright, tell me one thing. Why do people start business? To earn profits, right? So any activity done with the primary purpose of making a profit is called a business activity. Now, just like a store owner buys and sells products to earn a profit, a trader buys and sells financial instruments with the hope of making a profit. Now, you would argue that this is also true in case of investors. After all, everyone buys a stock with the motive of making a profit. And you are not wrong. But think of investing in stocks as similar to investing in a fine wine. There are people who collect wine bottles and store them for years in the hope that its value will appreciate as it ages. Similarly, people who invest in stocks look at stocks as real companies they are betting on and hope that these businesses will age well and their investments will grow as well. Hence, the notion is that investors would buy a stock and hold them for a long term, and they may not actively track their investments. By the way, if you identify yourself as an investor, you can also check out our last video on income tax for investors. Coming back to trading, like any other business, it requires you to act like an entrepreneur. You invest capital, make strategic decisions based on market trends, and deal with the risks associated with the market fluctuations. Purely because of the time and attention it needs on a daily basis, stock trading is no less than a full-time business. Now, all businesses go through the following cycles. They invest capital into the business, bear some expenses, make profits, or losses, or pay taxes on their net earnings, and eventually file their taxes. And this is exactly how we'll go about today's video, starting from earning profits from trading, paying taxes, and all the way to filing taxes. Okay, alright then, let's understand how do traders earn profits and tax implications on the same. See, any trader, whether he does intraday, F&O, or other delivery-based trades, can earn money in one of these two ways. You either buy low and sell high, which is the most obvious way. Second way is selling high and then buying low, which is, say, short selling equity shares. Now, whichever way you make money, profits from trading are treated as business income, and you will have to report them under the income from business or professions head. And depending on the nature of your trading activity, it is categorized into two subheads: speculative business income and non-speculative business income. Now, intraday transactions are considered speculative since you trade without taking delivery of the contract. That is, the stocks are not delivered into your demat account. Hence, it is considered highly risky, and profit from these trades is termed as speculative business income. Income from other trading activities like delivery-based equity trades, F&O, commodity, or currency trades fall under non-speculative business income. While your taxes don't get affected based on whether you have speculative business income or non-speculative, it does make a difference when you incur losses, which we'll cover in a bit. Coming back to taxes, unlike capital gains, business income isn't taxed at a fixed rate. Instead, both speculative and non-speculative business income are added to your overall income, which includes sources like salary, bank interest, rental income, other business incomes, and so on. The taxes are then determined based on your applicable income tax slab. Let me explain this with an example. Consider Rahul, who has the following income sources in a given financial year. He earns 10 lakh as salary from his job, 1 lakh as short-term capital gains from equity mutual funds, another 1 lakh in profits from F&O trading, and finally 1 lakh in profits from intraday trading. In order to find out Rahul's tax liability, we need to calculate his total income by summing up his slab rate incomes, which include salary and business income, that is speculative and non-speculative trading income. We'll exclude capital gains here because they are taxed at a fixed rate. Hence, Rahul's cumulative income from salary and business is rupees 12 lakhs. Now, taking the 50,000 rupees standard deduction into account, Rahul will have to pay tax on 11.5 lakh based on the applicable tax slab. If he has opted for old regime, he will fall in 30% slab and his total tax liability would be 157,500. But that's not all. Rahul also had an additional income of 1 lakh as short-term gains, which will be taxed at flat 15%. So that's another 15,000. Thus, his total tax liability for the financial year would be 157,500 plus 15,000, which equals to 172,500. Finally, adding the 4% health and education cess makes the total tax liability at 1,79,400. Hope you are clear so far. Now think about supermarket in your locality. It invests capital in setting up the store, incurs expenses like rent, staff salaries, and buying products, makes some profits, or who knows, losses, and finally pays taxes on its net earnings. Stock trading is no different. Hence, tax authorities allow you to claim various expenses directly related to trading as a business expense and reduce your tax outgo. These expenses include rent paid for space used for trading, electricity expenses for the office, employee salaries, mobile bills, telephone bills, and internet charges, depreciation for laptops and other electronics, courses, subscriptions, and book purchase for trading education. But remember, these expenses should be wholly and exclusively related to your trading business. Now you would ask me, it is not every time that I earn profit from trading. So what do I do in case of losses? Let's understand this right away. Alright, businesses are volatile. Trust me, I understand this. Especially stock market trading, which is a zero-sum game. Basically, for every winner, there's got to be a loser. Even a SEBI report last year suggested that 9 out of 10 individual F&O traders suffered losses in FY22, with an average loss of rupees 1.1 lakh. I know it's tough to digest losses, but if you do incur loss from trading in a particular financial year, you can do two things. Number one, set off these losses with gains from other income sources in the same year. For instance, let's say Aman made 10 lakhs from his restaurant, 2 lakhs in interest, and faced a loss of 2 lakh from F&O trading. However, his total income is 12 lakhs, but 2 lakh loss can be used to balance his incomes. So his effective taxable income would be 10 lakh rupees. And second, you can carry forward trading losses for a certain number of years and set them off against potential profits in the upcoming financial years. For example, Rahul made a loss of 1 lakh rupee from trading this financial year. And the next year, he earns 3 lakh in profits. So he can set off the 1 lakh loss against these profits and his net taxable profit would become 2 lakhs. But there are few important points to keep in mind. Check out this table. Non-speculative losses, such as those from F&O trades, can be set off against any other income head except salary income in the same financial year. This includes capital gains, interest income, rental income, etc. Further, you can carry forward non-speculative losses for 8 years. But remember, carried forward losses can only be set off against any future non-speculative business gains. Speculative losses, on the other hand, like those from intraday trading, can only be set off against other speculative profits. Also remember that speculative losses can be carried forward only for 4 years and set off only against future speculative profits. I hope this was clear. If you have any doubts here, let me know in the comments. Now let me address one of the most asked questions on our videos. Audit applicability for traders. I have a 10-year-old. He gets homework and daily assignments from his school. His mum, at the end of the day, reviews all of his assignments, cross-verifies it with the almanac, and ensures he has completed everything. Now, tax audit is very similar to this. Every business is required to maintain a balance sheet and a P&L statement, and so are traders. And tax audit basically means getting these books of accounts inspected by a practicing chartered accountant. They review everything and then submit the tax audit report to the income tax department. The whole point is to make sure you have provided complete and accurate information regarding your incomes, deductions, and taxes. But whether you need audit or not completely depends on your trading business turnover. According to the Section 44AB of the Income Tax Act, a business is required to have a tax audit carried out if the sales, turnover, or gross receipts of a business exceed Rs 1 crore in a given financial year. However, this threshold limit increases from Rs 1 crore to Rs 10 crore in case cash receipts and cash payments made during the year do not exceed 5% of the total receipts. In other words, more than 95% of business transactions should be done through banking channels. Since intraday and F&O transactions are 100% digital in nature, the turnover limit for tax audit is 10 crore for traders. Now, I won't dive deep into the nitty-gritty of calculating turnover for equity and F&O trades here. But if you want me to make a detailed video on audit applicability for traders and how to calculate turnover, let me know in the comments. Also note that turnover is only required to determine if a tax audit is applicable or not. Your actual tax liability does not get affected by the turnover. Alright then, let's move to the last section of this video, which is how to file taxes as a trader. Remember, we discussed about carrying forward your losses a few minutes ago. Let me tell you that you won't be able to carry forward those losses if you miss filing your ITR before the due date. In case audit is not applicable, you are required to file the ITR by 31st of July of the respective assessment year. And if your business turnover is above the audit requirement threshold, you will have to get the audit done and submit the tax audit report on or before 30th September of the relevant assessment year. And the last date to submit the ITR in this case will be 31st of October. Okay? Now let's understand which ITR form is relevant for you as a trader. The Income Tax Department has classified 7 different ITR forms, and which one applies to you depends on 2 things: the type of taxpayer you are and the sources of income. ITR 1 through ITR 4 are applicable to individual taxpayers like you and I. And out of these 4, ITR 3 and 4 are applicable for traders since income from trading is categorized as business income. For majority of the intraday and F&O traders, ITR 3 is applicable unless they have opted for presumptive taxation scheme. And if you opted for the presumptive taxation scheme, it's ITR 4. Now I can talk about another 10 minutes on what's presumptive taxation scheme and its details, but let's save that for another day. If you want a detailed video on this topic, let me know in the comments below. Finally, you would require a list of documents to file your ITR, and here is a quick checklist. Form 16. It has details of TDS deducted on your salary throughout the year, and you will get this form from your employer by 15th of June every assessment year. Form 26AS. It provides details of TDS and TCS deducted on your incomes and spendings, and you can get this from the income tax portal. Annual Information Statement. The AIS is a detailed statement that lists all of your financial transactions for a given financial year. These transactions include interest income, dividends, stocks and mutual fund transactions, international remittances, etc. It's important that the information mentioned in the AIS matches with that in the Form 16 and Form 26AS. You can download the AIS form from the income tax portal. Your capital gains statement. This contains your capital gains proceeds from sale of stocks, mutual funds, ETFs, etc. and is important to calculate the tax liability on your capital gains. You can download this statement from your brokerage platform, AMC, CAMS or Kavi. And last and the 5th one is tax P&L statement. This includes your trade-wise or script-wise profit or loss from stocks, MFs, ETFs, intraday and F&O transactions. This statement also includes expenses you can claim as a trader. These expenses include brokerage, STT, stamp duty, exchange transaction fees, etc. You can download this statement from your broking platform. Now, before you decide to file your ITR, remember that the new regime has been made a default regime from 1st April 2023 onwards. Hence, understanding and choosing the right regime is very important. While new regime comes with lower slab rates, the old regime provides the deduction benefits. So you must calculate your net tax liability in both the cases. And if you decide you want to opt for old regime, you will have to file Form 10 IEA in order to switch from new regime to old. Finally, you must understand that paying taxes and filing ITR are two different things. Payment of taxes should happen as and when you earn incomes in the form of advanced taxes. Advanced tax provisions apply if your total tax liability is equal to or greater than 10,000 in a particular financial year. And if it does, you will have to pay your tax liability in 4 installments as shown in this table. In case you fail to pay your advanced taxes on time, you will have to pay interest penalty on your pending dues under Section 234B and 234C. If you want to understand how to calculate your advanced tax liability and pay it, you can check a recent video on this topic. We'll put the link in the description. So that's it for this video. If you have any doubts from this video, suggestions for us, or topics you would like us to cover, shoot them in the comment section below. If you need our support for planning or filing taxes, reach out to our team on social media or through our website. If you liked this video, make sure to hit the like button and subscribe for more tax-related content. Until next time, this is Vishvajit signing off.